Okay, let's take a moment and look at the disclaimer. This content is for educational, informational, and entertainment purposes only. Nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We are here just to spread the word about how BTA analyzes the markets. This is Rod from BTA, and we are known as the middle traders. We are not going to get in at the exact bottom, and we're not going to get out at the exact top. But we will make a lot of money in the middle. We are the stock market masters. Okay, today I want to discuss something that's very important. It's the relationship between the TNX, which is the 10-year U.S. Treasury Yield, and the TLT, which is the ETF, that tracks the 20-year Treasury bond. Okay, so what's important to know here is that when Treasury bonds go down, the yield is going to go up. They move in opposite directions. Okay, so let's just look right here. This green line, the green line is the TLT. That's the 20-year Treasury bond ETF, the bond ETF. When that's going down, the yield, the rate, the interest rate, the return is going up. So just know, when bonds go down, the yield go up. When bonds go up, the yield is going to go down. They move in opposite direction. That's the main thing just to remember, okay? So now, why is this important? Because if the yield, interest rates is going up, it puts a lot of pressure on the stock market, especially new companies that's not earning any money. They don't have any earnings. Technology companies that take on a lot of debt. When that yield go up, that means they got to pay more money. That the interest rate is going up. They got to pay more money for the more. They got to pay more money for the interest that they have to pay on money that they borrow. Okay, so just like with us, if we have credit card debt, that credit card interest may be very high. Okay, but if we borrow money, we keep borrowing money at higher interest rates, we got to pay more. And it cuts into our bottom line. It cuts into the money that we have in our savings, or cut into our income. If we keep borrowing money, paying higher and higher interest rates, we have less money to do the things that we need to do in our day-to-day lives. So that's the same thing with a company. If they borrow money and the interest rate, the yield is going up, that means they're paying more interest on the money. It's going to cut into their earnings. They're going to cut into their bottom line. Then the company's going to earn less money. So we don't really want to see that yield going up, because that puts a lot of pressure on the stock market. But if that yield start coming down, okay, and that means that the bonds are going up. That means somebody's buying the bonds. The institutions are buying the bonds, and the bonds are going up. The yields is coming down. That could get a little relief in the stock market. That could be a setup for a bounce. Okay, so now let's look at that. Okay, let's take a look at that. Let's look at the TNX, the yield, okay, the yield on the 10-year Treasury note. Let's look at this is the most recent action here. Okay, so notice we got the white line, which is a 5-day moving average. Okay, we got the green is a 9 and the yellow is a 21. This is a 50-day moving average. So right now the yield is coming down. It's trying to trend down, but it may find support. This is yesterday's action right here. It traded right down to the 50-day, this red moving average. and it kind of found support right there. So the question is, are we going to break through this 50-day moving average, okay, and then start finding resistance from the bottom and then keep heading our way down? If that happens, that means the yield is going down, okay, and that could take a little pressure off of the stock market, okay, especially the Nasdaq, because the Nasdaq has a lot of newer company, newer companies in there, uh, uh, technology companies, new growth companies. So those companies a lot of times have a lot of debt. So if that yield could come down, that could take a little pressure off their bottom line. Okay. But what we have to see here now is if the 50-day moving average, which is the red line, is it going to act as support? Okay. That's what's important here. Now let's look at this is the same 10-year Treasury yield, okay? But I drew some lines on here. And note, you saw we was coming right down to the 50-day moving average, right? We want to know if it's going to find support. But notice on this chart, okay, we did break below this internal trend line. But we right here at key support levels from this fractal right here. We have a fractal right here. That's a key support level, this fractal right here, okay? So that this horizontal support level is almost lining up directly with the 50-day moving average, right? So can we get below this? Can we break below this support and then may rally up, find resistance, and keep heading on down? If that happens, then the yield is coming down. And like I said, it's going to take a lot of pressure off of the NASDAQ. That could set the NASDAQ up for a little rally, okay? But we have to see if that's going to happen. Now, here is the same 10-year Treasury note, but we have the RSI on here, okay? The Relative Strength Index. And this is good. We're below 50. Can we stay below 50 and come on down toward the 30 level? And we are up here I have the Bollinger Bands, and if you notice, we are inside of the sell zone right now. Prices are inside the sell zone. Can we break the 50-day? Can we break this support? Can the RSI stay below 50? And can we come on down and stay inside the sell zone? If that happens, a lot of pressure could come off the NASDAQ, okay? A lot of pressure could come off the NASDAQ. And this is the rate of change. The rate of change is negative right now. That's actually good because we want to see it. We want to see this TNX.X. We want to see this chart, the 10-year Treasury note yield, come down. So we want to see this stay in the negative area, okay? As far as the rate of change. We want to see it staying in the negative area. Now here we have the MACD and the stochastic, okay, at the bottom. 10-year Treasury yield up top. This is 10-year Treasury yield up top. This is the same 50-day moving average right here. You see we found the support right at it. Can we break below it? But you have the MACD here, and we do have a bearish crossover. The histogram is in the red. But it would be nice to see this MACD line come on down and get below zero, okay? The stochastics is showing the oversold area. That's good, okay? It's below 20. That's good. If it started rallying, we want to see it definitely come up and maybe find resistance at the 50 and turn it back down. And the KST, okay, is showing a lot of negative downward momentum. That's all good because we want to see this TNX come down, okay? Now, the guppy is coming down, but the magenta line is the closing prices of the TNX, right? It's a line of closing prices. It's below all of the short-term moving averages, which are the green moving averages here. But if you see the magenta line is now inside of the longer-term moving averages, which is the red moving averages. Well, that could find some support. We want to see it come on and break straight through that, okay, and start coming on down. If it starts finding support in this area and bounce, well, the yield may start going up. That's sufficient pressure on the market, and you might see the stock market start to roll over again. So here, this is good, okay? This is Ichimoku cloud of the TNX, the 10-year Treasury yield. And notice we do have a TK crossover. The Tkinson, which is the yellow line, okay, the yellow moving average, and the Kijisen, which is the magenta, we do have a crossover. In other words, the yellow moving average line is the faster, and the magenta is the slower. The faster moving average did cross below the longer term moving average, the slower moving average. That's good. Prices is trading down, but is it going to find support in the cloud and start running back up? That's the question. We want to see this thing keep coming down, moves a little sideways, and try to get through the cloud. It's a possibility it may come down into the cloud and find support and run right back up. If that happens, we might see the NASDAQ starting to roll over again and starting to sell off. Because like I said, if interest rates start going up, if the yield goes up, it's going to put pressure on the overall market. Okay. And now let's take a look at our chart of lowest. Okay. And as we can see, this is good. Okay. Because lowest is telling us, all right, we got the red line, the magenta line above prices, and we below the 21-day moving average. That's good. We want to see price continue to stay below the magenta line. It's just like when prices are going up, lowest puts that blue line underneath price. When prices are going down, lowest flips and put the magenta line above price. As long as price is staying below the magenta line, then that's good. That's downward momentum, downward price action. Okay, so lowest is saying that the 10-year yield is now in the downswing. Okay, we got to see if it's going to start trending down. It is definitely in the downswing, and that's good. Okay, as long as lowest stays below the magenta line that's above price, don't break back above that and stay below the 21-day moving average, then yeah, prices may, the stock market may settle down and get a bounce, okay? Because the yield is coming down. Now I'm going to do a part 2 of this, which is going to look at the TLT, okay, which is the 10-year Treasury bond, because we know if that continues to rally, then the yield is going to continue to come down. Remember this, let me bring up the, remember this chart, okay, the comparison right here. Remember, we just looked at the 10-year Treasury yield, okay? We want the yield to start coming down, okay? But if we start seeing the yield coming down, then quite naturally we should start seeing the TLT, which is the 20-year Treasury bond, start moving up, okay? And if that happens, if money flows into the bonds, okay, and the yields start coming down, then guess what? We just might see that market bottom that we've been looking for. So it's a lot of things that's pointing to the fact that we may get a market bottom, okay? Go back and look at the other videos that we did, okay, earlier yesterday, and we talked about all of the bullish divergences that are out there, that the market is not looking as weak as it seems, okay? All of the bullish divergences that's there. Okay, the Fibonacci extension, the Fibonacci retracement levels are showing us some very interesting things where we're coming to very key support levels. Okay, go back and look at those videos, and I'm going to do a part 2 to this, which is going to be the the TLT, like I said, and if we're going to analyze the TLT, and if it continues to move up, and it looks like it wants to move up, okay, the yield is going to come down, and it's going to line up to everything else we've been looking at. We may get that bounce, that tradable rally in the market that we're looking for. Okay, so look for part 2 to this, which is going to be the 10-year, the TLT, which is a 20-year Treasury bond ETF. Okay, see you in the next video.